Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup. This is for the trading week ending October 21st, 2022. I'm Preston Brent. Thanks for tuning in. Well, this week's theme is House of Mirrors. There are a lot of things going on the surface of the markets, like this week's strong run higher, but there are a lot of things going on underneath the surface that can cause a lot of problems in 2023. If we take a look at what's going on, let's just take a look, first of all, at where we were this past week. You can see here, everybody was very solidly in the green camp. Dow, S&P, NASDAQ, Russell, all up. In fact, it was the best gains that we've seen weekly in over 4 months for most indexes. You know, a lot of investors appeared to be reacting to some prominent earnings results, but also probably even more important was hints that were published in the Wall Street Journal on Friday that some Fed officials may be beginning to signal their desire to slow down the rate hike or the pace of increases, and then put a pause on. So what that did was there's a 75 basis point rate hike scheduled for this November 2nd. That's already pretty much baked into the markets. I believe they're going to do that. But then for December, there was a 75 basis point rate hike that was built into it. Now that's a coin toss between 75 and 50. I suspect they'll come in at 50. So what that's done is added a number of uh, um, price move, or let's say stronger price move to the upside, just on that report out of the Wall Street Journal. And they tend to call, they have the Feds have officials that release data to the Wall Street Journal and then they leak it. So it's really it's really not a leak. That was the intention, to just kind of keep the markets in line with what the Feds are thinking. Okay. So we've got a very strong week this week, but still year to date solidly in the red. Everybody's in a bear market with the exception of the Dow. You can see valuations. The forward PE ratio still, I think, elevated, at least 1 or 2 points higher than it should be. We will start to see more continued revaluations going forward of individual stocks. Dividend yield in the S&P came in at Friday's close at 1.79. U.S. Treasury 4.21. So the U.S. Treasury is 242 basis points higher. So there's going to still be a lot of money flowing into the Treasury market compared to putting it in equities, right? I mean, right now T-bills are yielding almost 4% for 90 days. So it's a great place to park cash until markets stabilize a bit more, and we're seeing a lot of big money doing that. Okay. Earnings yield is at a little over 6%. The yield over the 10-year Treasury is still 2.33. So there is some attraction to equities. A lot of big money's trying to make the assumption that maybe we're bottoming right now for this year. So we're seeing some more buyers coming in at that point. But I still think the lows, I believe, have probably been made for this year. But as we go into 2020, I think we're going to make new lows. You can see the current VIX closed the week at 29.69. Last week it was at 32.02. So it's down just a little bit, but we're staying stubbornly high. Because it's going to be like this until we get through the Feds on November the 2nd. Keep in mind, we get a big CPI data print about a week and a half after the Feds. We get midterm elections, so there's still going to be bid and volatility, and it's going to stay elevated. Okay. So, and you can see the best performer for the week, energy. Worst was utilities. Energy year to date is just kicking it. They've led the way since the first week of January. Right now, it's up 61.65% year to date. Communication services bringing up the rear. In fact, energy is the only sector in the U.S. that's in the green this year. All other sectors are in the red. Of course, with communication sector bringing up the rear. But in a rare week, we had even the worst sector was in the green for this week. So this was a little bit of a combination of a short squeeze and then money trying to find a bottom. And we'll see how that plays itself out. Meanwhile, if we come over and look at European markets, you can see everybody was in the green. Euro stocks, FTSE, CAC 40, DAX, all in the green. Year to date, everybody's still in the red. Shares over in Europe rose, I guess, especially in the UK, on resignation of the UK Prime Minister Liz Truss, which meant scrapping her fiscal policies, which really undid the British markets for a very short period of time. Meanwhile, European bond yields are climbing ahead of an ECB meeting. They're expected to hike their rate 75 basis points as well, in alignment with the U.S. Feds. Okay, but the Bank of England confirmed it's going to begin selling bonds on November 1st under their quantitative um, uh, tightening program. All right, because they accumulated a huge balance sheet when they were doing QE. And the UK also reported inflation as at 40-year high. It came in at 10.1%. Prior month is at 9.9, so still extremely, extremely high. So Europe is still having their problems. And this winter, energy prices are going to be through the roof, so it's going to be very, very tough for consumers over in Europe. Well, let's do this here real quick. Excuse me. I forgot to cover the Asian markets. If we look at Japan, the yen week. Just hang on one second, guys. Hang on just 1 minute here. I gotta let me just do this real quick. Okay, sorry guys, I'm back at you. Over in Japan, China, and Hang Seng over in the Asian markets, all in the red for the week. Year to date, like the rest of the planet, is all in the red also. But the yen continued to just get very weak this past week. It went up over 150 to the dollar. It's over a 32-year low. So the Bank of Japan initiated emergency bond buying operations late this past week, purchasing bonds basically with maturities between 10 and 25 years. And what they're doing is, in order to support the yen, the BOJ sells dollars for yen. Okay. Now, most of those dollars in Japan are invested mainly in U.S. treasuries. So they're selling treasuries. And by selling treasuries, that puts more upward pressure on U.S. interest rate yields. Okay. Because when you sell treasuries, bonds go down. They're selling bonds, bonds goes down, interest rates goes up. But they're doing this to support the yen. I suspect what's going to happen in other countries, you're going to see the same type of thing. In order to support their currencies, they're going to be selling some of their treasury holdings and then buying their own currency, and that's going to support the currency. So that, in a way, is going to raise interest rates even further. It's going to be one of the tools that emerging markets and even over in China, right? They're doing that. So, and speaking of China, really weird. They're finishing up their 5-year meeting. Every 5 years they meet and pick a new leader. But President Pet is, this will be his third 5-year term. So he's kind of in there for life, I guess. But China stock market recorded a weekly loss, primarily after Beijing delayed releasing its economic data without explanations. Now, they probably didn't want to release it during this 5-year meeting that all the muckety mucks had, because they were all tied up in these meetings. But China's Statistics Bureau announced last Monday that it would postpone releasing Q3 GDP and other key indicators like monthly readings of industrial production, fixed asset investment, retail sales, blah blah blah. So, of course, you can do that in a communist controlled country. So they just said, "Oh, we'll release it later." So markets sold off because I believe China is going to have some hurt coming onto it over the next 12 months. And by the way, the Bureau didn't say when they would publish the data, but I suspect it'll be published this coming week. Okay. But the delay also raised speculation that their Q3 GDP is going to show that Chinese economy was on track to miss its official growth target of around 5.5%. So China is still hurting. Okay. What I want to do is just shift over. Let's go to some of the charts here. And let me just shift the screen a little bit. Let's get over here like this. What we're going to do is we're going to go over to the E-mini S&P 500 futures, a daily chart. You're going to see here, my target was around 35 to 3,400, as I told you. We actually came down and hit 3502, so right at the top edge, top boundary of my target that was hit on October 13th. And you can see the choppy nature of the markets, up, down, and We're coming right back up around that 38% fib node. If we can clear this level up here, which is around 38.20, then we're going to be running a little bit. Now, my key level that I want to see cleared, there's actually two here, but the big one is right here. This one is at 4,300. Now, can we clear that before the end of the year? I don't think so. But of course, a lot of it depends on what the Feds are going to do on November 2nd. Where is the interest rate trajectory? When are they going to pause their interest rate hike? They may talk a little bit more about it. But again, we're going into the Fed meeting on November the 2nd, and we don't get the September or the October inflation data, including the core data, until around the 13th of the month. So, and they're not going to have that data either. So that is going to be a very heavily watched data point. But assuming it comes in very high in the Feds, even though they may do a pause, I don't think we're going to hit this level up here. We got several resistance points up above us that we could come up and challenge. But I do believe that assuming inflation comes down just a tick or two, 10 or 20, 30 basis points, and the Feds indicate they're going to pause sooner, then that'll give us a lift in the market through the end of the year. And then I think in January, February, when we start getting Q4 earnings and projections in Q1 and Q2, after a lot of these interest rate hikes have started to take effect, I think we're going to see the markets roll back over again and we'll make new lows. I've seen some estimates at fair value based on current projected earnings once they come down to a more acceptable level is probably around 3,000 to 3,200 in the S&P. But we've got to see what the Feds are going to do with rates and just what they will and will not do in support of the markets. Okay. So this is what I'm looking at here. And of course, if we look at the Dow is the best performer. You can see it's up over 800 points. We came down, hit my target in the Dow like the S&P. We hit this low on September 30th. We were down about 21, almost 22%. We've taken out the 50 EMA. That's a key give right there. Notice over here, the last time we closed over the 50 EMA for more than 2 days in a row was back over here in August, on that big run up in August. So we're over the 50 EMA on Friday. Can we hold it? If we can, we're probably going to make a run to the 200, right? And I believe that's possible through the end of the year. I've been telling our members that we should have a little bit of a bounce through the end of October, a little bit of a settling in leading up to the Fed meeting, and then, it's a coin toss what they're going to do, but that will drive the markets, okay? And if we look at NASDAQ, it had a strong day as well. We came down also and hit my target in NASDAQ as well. We hit it on October 13th. We were down 37.5% roughly, but it's well south of the 50 EMA. That's going to serve as overhead resistance. So we've hit the target in all three of my indexes, NASDAQ, the S&P, and the Dow. The only one that didn't quite get down there was the Russell, okay? Now, the Russell, you can see here, I had a target over here we hit perfectly, and then I projected another target low over here. Let me get it up on the screen. Down here around 1565. We didn't quite get down there. We challenged this low over here, and now we're running up. So to me, I want to see indexes climb over their 50 EMA and find support at the 50 EMA should they pull back. If that's the case, and then we get a lift up from there, we're going to have a nice little run, all right, before the end of the year. If we don't get that and we roll back over, then it's probably going to be due to the Feds and inflation. So inflation and the CPI data print coming out in November is really going to dictate where we're going to spend November and December. Okay, it's going to be very important. And of course, if we come down here and look at volatility, let me just look at the VIX here. Where is it? Here we go, right here. The VIX finished below 30 on Friday, but look at how long we've been up here. And every time we get down, the last time we've been down in the high 20s was back over here in early October, about 3 weeks ago. So we're coming back down again, but either way, we've been elevated for quite some time, okay? Now, we've never really had a flush where the VIX goes up over 40, because if I move this back to include all of 2022, right? Here we go, right here. This is all of 2022. You can see not once did we move back up and close over 36.47. We had one close right at about 36.47 back in April of this year, but outside of that, we run up intraday and then we sell off. So I would expect the same this time as well. Okay. So we get up into above 30, but then we don't stay. It's very choppy. Okay. And then we just kind of bounce and then we bounce back down again. Okay. So that I want to see, and I told our members I wanted to go into Friday's close above 3,700 and with the VIX below 30, and we hit both. In fact, the S&P futures was over 3772, so just south of 3800. So let's see where we can go from here. And of course, if we look at treasuries, bond market was down hard, which meant interest rates were up. We've blown right through my projection for the bond market. Okay, now my projections, you can see the last time we blew through the projection, we rose back up over it again. You can see we've gone through this projection here, and we came down and hit a low of 118.06. What this means is there are a lot of other countries out there, like I said, the Bank of Japan, China's doing the same thing. They need to support their local currency. So they're selling dollars, and they do that because they're holding treasuries in dollars. So they sell their treasuries. It drives up interest rates. But it supports their currency. So we're getting some of that as well here on this. And if we look at the 10-year note or 10-year interest rate right here, you can see we hit some intraday highs here, right? And I haven't even marked it, but let me just show you here. Let me just zoom down here. If we look at the 10-year high, I mean, wow, look at that, right? Blew right through it. Okay. Now my Elliott wave count is projecting that the 10-year can run all the way up to 5.8%. And if inflation stays sticky by the summer of next year, by the fall of next year, we could get up there. But if we get up there, we're going to have a hard recession and it'll be a hard landing. Okay. But that's what the Elliott wave is suggesting. Near term, however, I think we're going to come back down and probably test the 50 EMA. It's going to back off a little bit. And then we'll kind of see where we're going to go from there. Okay. If we look at currencies, let's look at the dollar. The dollar has been on fire except for Friday when the Feds talked about easing. Notice the dollar's the last all-time high, or not the all-time high, but the 2022 high was made back over here on the 28th of September. And I think the dollar is going to come down and test the 50 EMA. I've been itching to go long the euro, right? Because the euro will trend once it starts to run, okay? And you can see the euro. We hit our low here in the euro at 0.9592 to the dollar. Really amazing. And now, but we have not been able to get over the 50 EMA. I've told our members, let's wait. Let's recapture the 50 EMA. Once we do that and we see it hold, then I can see it running up to the 200 EMA. Okay. Let's look at the yen. The yen is the one that's just been totally decimated. And here you can see the yen, and that was a little bit of support from the Bank of Japan right over here. But let's just put it on the weekly chart just so you can see how ugly this has been. And I kicked myself because this was one trade I should have jumped into, but I didn't. You can see back over here, right around January of 2021, the yen just started falling off the table. And just the opposite of the dollar. And this is suggesting that we're going to have a nice little run up in the yen, and then it's going to roll back over again. Okay, so that's suggesting 2023 could be pretty ugly as we get into it. It'll be hard to see, but that's kind of what the markets are teeing themselves up for. And then, of course, if we come over here and let's go back to the daily chart, and I'll show you gold. Gold had a strong day on Friday, but I'm still not a believer in gold just yet, right? You can see we did a test of gold at our previous low that was made back over here on September 28th. We did the test and we just bounced hard off of it. Notice we get a little bit of a bearish divergence or a bullish divergence here. So gold could run up a little bit, but I'm not ready to go long gold yet. Okay. Generally, a lot of our inflation is caused by supply chain issues, and supply chain issues versus demand issues tend to not drive gold up as much when you've got inflationary issues going on, right? Mostly caused by supply chain stuff. So I'm not really ready to jump onto the gold bandwagon yet. But if I see some more upside and I see key levels supported, then I will be. And then, of course, if we look at copper, copper had a good day also on Friday, like everybody else. But I want to see it get over the 50 EMA. You can see here how it's struggling. My target for copper out in time was down here around 292. Okay. Now, some people are playing copper via FCX, Freeport McMoran, which we've done as well. But right now, it's just very choppy to do, unless you want to play long term and just bet on a global recovery. But I think 2023 is going to be ugly. And then when it comes out of it, it could be in the first half of 2023, and then we have a strong recovery in the second half. But I got to see a little bit more data points on inflation in the Feds before I make a call on that. Okay. And then, of course, if we look at oil longer term, believe it or not, I like. We've been long oil in and out. You can see oil is moving up and down. It has moved down from the high point of 122 a barrel back over here in the summer months. But I think in this area here, we've got a way to trade oil that's just working out great for us. And members know what I'm talking about. Right now, I'm just more of a steady state with oil. I think it's going to stay in this range for a bit. I think it may move up just a little bit. And members, one of the things we'll talk about as we get through the end of October going into midterm elections is just kind of what to expect if we get a Republican sweep versus we get a split between Republicans and Democrats, Senate and House. And just which sectors will tend to fare better versus others. And then I give you some just overall stats on how that can work out. But this is what I'm looking at now in the energy market. And of course, if we look at nat gas, um, right over here, I told our members to get short nat gas over here and up here in these levels. You just have to short natural gas here. But you can see it's falling off the table here. It's getting down to more believable levels to me. Now, if we have a cold winter, we can always have that rip higher. If it rips higher, I'm going to want to sell into that strength, right? That's the way I would look at nat gas. All right, everybody, that's our weekly roundup for this trading week ending in October 21st. Members, I will see you Sunday evening. We got a lot of stuff to cover and some interesting plays that we can make. Have a great weekend, everybody. Enjoy college and pro games, football, baseball series if you're a sports fan. I will see members this Sunday evening at 8 p.m. Eastern Standard Time. Take care, folks. Ciao now.